Are you confused between the terms pre-qualification and pre-approval? Hi, I'm Chris, and in this video, I'm going to be explaining in detail the main differences between the two terms. I think a lot of the confusion comes around these days because we get a lot of junk mail, especially junk postal mail, from banks and credit card companies about that we are pre-approved, that we have a pre-approval from, for either a specific line of credit or maybe even a loan for a home or a car. And that term gets used around very loosely. But in the mortgage world, there's a very distinctive difference between the two terms of pre-qualification and pre-approval. So on this slide, you'll see that a pre-qualification is a verbal confirmation or verification of a few basic data points that you will be providing to a loan officer or mortgage loan originator. You can see here that the basic data points are credit score, income, value of your property, the loan amount, the property zip code, and the loan purpose. With this piece of information, a mortgage loan officer or a loan originator should be able to provide you basically an estimated quote on your rate, estimated closing cost, based on the information, as long as they're in front of a computer. Now, the main difference between a pre-qualification and a pre-approval is here. A pre-approval, now by law, a loan officer must be able to provide you a pre-approval letter if you request it, regardless if they were able to verify these three main points of information. Now, for us and most loan officers out there, they're going to want you to provide you the information because we don't want this pre-approval letter, which comes after being pre-approved, the pre-approval letter to be worthless. I have a video, check it out. Basically, I explain to you why you don't want that. But here for a pre-approval, a good loan officer is going to want a loan application, the documents for the loan application, depending on your situation. So if you're a W-2 employee, then typically they're just going to want to verify your income, your assets, and then the last thing would be pulling your credit to make sure what your debt load is as well as what your credit score is. Now, if you are self-employed, then it's going to be anything from all your tax returns, maybe your business tax returns, as well as the year-to-date the year-to-date P&L to verify that your business is still having profitability. It's going to require these three. Now from here, what the loan officer will be doing is they'll be pre-underwriting your file. So based on the guidelines, if you're going for a conventional loan, it could be a jumbo or any other VA loan as well, or a USDA. But let's say for a conventional loan, they're going to be pre-underwriting your file based on the guidelines that Fannie Mae and Freddie Mac has provided. And this is public information. So based on those guidelines, they're going to take a look at your scenario and match it up and to make sure that your file is doable, basically. And from here, then they're going to go into what we call issuing you a pre-approval letter. The main difference between a pre-approval and a pre-qualification is after the pre-approval, a loan officer is going to be issuing you the pre-approval letter. That pre-approval letter is important because your realtor is going to want that pre-approval letter to make sure that you are pre-approved for the mortgage that you are saying that you want to get for whatever home or price range that you're looking for. Just understand the maximum pre-approval amount is different than your affordability amount. Okay, so your pre-approval amount means that your back-end DTI typically can go all the way up to like 49.99% of your gross income, so before taxes. But most of the time, that's not going to be your affordability because you're going to have groceries, you might be helping your parents out or whoever out, and you're going to have car payments and other things, tuition, student loans of such. And so your affordability, while your back-end DTI could be all the way up to 49.99, I'm going to guess that your affordability is going to be right around 30% of your gross income, okay? Or maybe even 25%. So that your net income ratio for your mortgage or housing payment is going to be right around 33%. So just keep that in mind. But so I digress. So from there, after your pre-approval letter, you provide it to your realtor. You're going to be looking at homes. And then once you find your home, you're going to provide and submit your offer for that home with your pre-approval letter attached to that offer. Now, and that's the big critical difference between a pre-approval and a pre-qualification. By the way, if you're new to the channel, I'm Chris, a mortgage professional, and my goal is to unpack the secrets around the mortgage process. Consider subscribing and hitting that like button. If you like this video, you'll probably like my next video about the 6 most important milestones in the mortgage process. Thanks, talk to you later.